Good evening. Welcome to the workshop of the business plan competition, and the topic, as you probably know, is financial projections. And I'm glad we have a fairly small group, because I'd like to go around first and just have each person introduce themselves. You know who I am from what it says up there. I'm the founder of the GWBizPlan competition, which is about to have its 5th annual competition coming up January 28th. When the business plan executive summaries are due for the 2013 5th annual competition. I want to get started right into the meat of the program here and talk about the GW Business Plan competition and what's coming up for the 2013 edition. We've increased the dollar amount of cash prizes on all the palm cards I saw being handed out. It said $60,000, but I think if you add up the amounts here, it's like $62,000 now, and it could go higher. But I want to point out that in addition to the prizes we awarded last year, which were a total of $50,000, the 40 and the 10, we've added some new ones. Actually, we did have the Audience Choice Award last year, but it was just $1,000, so that's gone up to 3. But the 2 new ones that you can qualify for, they're totally wide open, and hopefully we'll have at least a few teams competing for each of them, because it's a lot of money. That $9,000 has got to go to somebody, right? We're going to have one called the Older Adult Focused Innovation category, sponsored by the AARP Foundation, and that's for a product or service that's targeted at low-income seniors. All the rules are spelled out on the website, but something like approaching 20% of the population of the United States are seniors. And they have a lot of needs, and especially the ones that have low income. Needs for transportation, for food, for various essentials. And you can read on the website what the categories are that you can enter that in. The other new one is the Sustainable Technology Prize, and that's going to be at least $4,000. It may go up if we find another sponsor. By the way, all these funds are donated by sponsors like Capital One Bank and others who have pitched in to make this possible. Sustainable technology is a combination of sustainability, which is the new campus-wide minor we have here at GW, with a tech company. So, and again, that's spelled out in more detail at GWBizPlan.com, which is our website. The deadline for entering, I mentioned earlier, is January 28th, 2013. At 11:59 p.m. And all you need to enter is a 2-page executive summary. It's really pretty simple. We have judges that read these executive summaries, provide feedback to the teams, and then we take the top, however many we think are really good, viable business ideas. Last year it was 32. And those people go right to the semifinals. Also, the 2 teams that won Pitch George will automatically go to the semifinals. In both the graduate and undergraduate divisions of Pitch George from a couple of weeks ago. And then from there we go to a final round of 8, and that's the one we were just talking about earlier with Michael here, who was actually in the final 8 2 years ago. What you have to include in your executive summary to enter the business plan competition, again, all the details are on the website. There are basically 7 sections of a business plan, and you have to touch on all 7 of those areas when you write your executive summary. And the one that teams have had quite a lot of trouble with historically, not all teams, is the one having to do with finance. So that's why we're having this session tonight, to talk about financial projections and how you determine what your pro forma or projected income statement is going to look like, or what your pro forma cash flow is going to look like. If you're burning cash, how much cash do you need in the form of capital up front in order to fund that operation to get you through to a break-even point? Those are the concepts we're going to be covering tonight. We'll be talking about equity capital as well as debt or bank finance capital. That's why Capital One Bank is here. And when we get to the end of this, I'm actually going to demonstrate a model, a tool that's really based on Excel that is, again, available on the website that you can use to generate your financial projections. and it'll turn your income statement into a cash flow forecast and show you, amount of capital you need and various things like that. So it's a neat little tool. And then we're going to finish up with Sam from the Venture Capital and Private Equity Club making available, and this is a whole new thing this year, members of that club who are experts in finance for the teams here that feel they need a consultant in the financial area to help them really nail this business plan competition and do well. Because we're really here, as Denitza said, to help you do well and to have a great business plan and ultimately a great business. Start with the requirements of this financial projections section of the business plan. And by the way, when you get to the second round, the semi-final round, I should say, of the business plan competition, you'll be writing a 15-page business plan, which is really an expansion of your 2-page executive summary. And the 15-page business plan will have probably, for each of the 7 sections, probably 2 pages. Actually, you get 1 extra page for one of the sections, so 15 total pages. And in that document, you need to include all the items on this slide. In your executive summary, you only need to touch on this. Like, for example, you might want to mention the amount of capital you're trying to raise and what your income statement looks like for the first 2 or 3 years. You don't need to go into all the detail that's required in the 15-page business plan. Obviously, you won't have room in your 2-page executive summary. But in that summary, as it says on the website, you should touch on each of the 7 areas. So on your financial projections, you can decide which of these items you want to include and touch on. Any questions about any of this so far? I know we have a lot of people in the room that are finance majors that are very advanced. We have other people that probably are new at finance. So I want to make sure everybody understands what we've talked about so far. Great. This is a very straightforward income statement. Who knows what GAAP, G-A-A-P, stands for? Maurice?
Generally accepted accounting principles.
Generally accepted accounting principles. And so you have to follow the rules of GAAP when you do your income statement. And we'll be looking at cash flow later, which is a different animal. It doesn't follow GAAP. But when you're following GAAP, it's what's called accrual accounting. So if you make a sale, let's say this is just sort of an imaginary company, XYZ Corporation, and let's say you're starting this new company next May when you graduate. And in the first month, you're expecting sales of $2,000, as it shows there. And that those sales will increase each month through December. Be up to $16,000 of revenue in December. So it'll be $72,000 total for all of 2013. Then you show a projection for, again, 3 years is the minimum, which would include 2014 and 15. So revenue is pretty straightforward. But as you'll see later, you may not have collected that money in the form of cash yet, especially if it's a B2B business, because businesses always want terms. They want to pay on net 30 or net 60, or if you're dealing with the federal government, it may be net 90 days before you get paid, or 120 days. So you have to make adjustments to this. We'll be doing on the next slide. But you need to show it this way on an accrual basis, which is generally accepted accounting principles. Same thing for the expenses. Cost of goods sold are always shown as your first expense. And in this example, we've just shown 50% of revenue or sales as being the cost of goods sold. So that's pretty easy to figure out that line. It's just 50% of the sales line. Then you have fixed costs of some kind. It says rent, etc. So it's whatever overhead costs you have for running your business, such as rent. Depending on the type of business, you may have other fixed costs, utilities, phone bills, internet bills, things that come in every month, general bills for your whatever your business is. And then you have something called depreciation, and this is a a result of any money you've invested in capital up front. If you had to buy some computers, if you had to buy some chairs for your office, furniture, all that. And in this example, we've assumed the depreciation is $250 a month, which happens to be based on a $9,000 expenditure on capital expenses depreciated over 3 years. So 9,000 divided by 36 months is $250. And so that's shown, it spreads the $9,000 out over the 36-month period, which is the useful life of the assets you purchased. And then last, you've got some salaries, wages, benefits, things like that you need to include. And this one, it's just a one-person startup, and they're going to pay themselves $4,000 a month initially. And then obviously it goes up later when you get out into year 2 and 3, as they either have more people coming on the payroll or they pay themselves more money, whatever. But the interesting thing is, when you go through this, Excel, and this model that we'll be demonstrating later does all the math for you on all this. It shows you what your profit or loss is each month. This has a total $6,000 loss in the first year. But what would you guess is the amount of capital you would need to start this business? You're going to lose $6,000 the first year, so obviously it looks like you need $6,000. But can you tell by looking at this how much capital you're going to need to raise to start this business? Anybody want to guess about how much?
Twice.
Okay, so you say raise 12 grand, something like that, so you have raised twice. Okay, that's a good guess. Everybody else want to guess what the capital need is to get this business going? Sam?
Well, I would erase your sales for the first years and use whatever that total is.
Assume 0 sales the first year. Okay. Actually, if you really thought you weren't going to sell anything, you should put that in the projection. But you're a conservative guy. You want to make sure you have enough capital to get through. Anybody, any other guesses?
I'd probably say for the first year with total expenses. For the first year, 78.
So you try to raise $78,000? So that's really kind of what Sam says. Take all your expenses, assume you're going to have the expenses, but don't assume any revenue at all. Of course, I would have advised you, if you really thought that, you would have used more conservative numbers on the sales line. But let's go to the cash flow, and I think this will help answer the question. And this is really, these are the same numbers, but it's a B2B business, and so you can't collect those sales right away. There's a 2-month lag on collecting the sales, or we're assuming here, there's a 2-month lag on collecting sales. So your $2,000 that you sold in May, you collect in July. And what you sold in June, you collect in August. So everything's delayed by 2 months. Actually, it works in your favor on cost of goods sold, because if you're smart, you will have negotiated a deal with your supplier that you get your goods from, that you don't have to pay them until the next month after they're delivered. And that's pretty normal. That's easy to negotiate. So that's what we assumed here, is that cost of goods sold, instead of being $1,000 in May, you actually pay the $1,000 in June. So this is cash-based. It's the yellow lines that are the ones that are different from what we saw in the income statement. So it's the revenue line where the sales are, it's the cost of goods sold line, and who can explain why the depreciation line all of a sudden shows 0? Anybody can explain? It was $250 a month before, remember that? Why is it 0 now?
It's not cash flow.
It's not cash. You bought that equipment up front, those PCs or chairs, whatever it was you were buying for your $9,000. You were out of pocket for that up front. That comes in down here. It's what's called an investing activity. Which brings me to another important thing you need to know about cash flows. There are 3 types of activities that comprise your total cash flow. There's the operating activities, which come from the income statement. That's everything down to here. There are the investing activities, where you're spending money on capital equipment of some kind. And fortunately, there are financing activities where you're raising money. to help finance your business. And that's what we're trying to figure out is you know, how much we need to raise to make all this work. So getting back to the question about whether we need $12,000 as Maurice guessed, or $78,000, or whatever the number is, this is getting us closer. It shows it's really $26,000 of negative cash flow from operating activities, plus the other $9,000 from investing activities, so it's a negative $35,000. Let's assume everything goes right. What is your name? Matt. Matt suggested everything's not going to go right, and I agree. You want to raise more money than you need. So how much do you raise? It looks like if you hit your projections, you only need $35,000 to get through the first year. $9,000 for your capital expenditures, $26,000 for the cash burn on your operating activities. How much cushion do you need on that negative $35,000 of cash burn that you're projecting? Is there a right answer to that question? I don't think there's a right answer. It depends on how volatile you think your business will be, how much fluctuation there could be. If it could fluctuate all the way to the point, as Sam proposed, where you have zero revenue coming in on the top line, that would take another $42,000 off. So you'd add 42 to 35, and you'd be raising 77,000. And you said 78,000, didn't you? Matt, it's very good. But that's if you're really cautious and you think you're not going to make a penny of sales. Which probably means you didn't do a very good job of your market research and your business plan and your analysis of the supply and demand for your new product or service you're going to offer. But I don't want to get into that. When I studied entrepreneurship, when I was getting my MBA, we pressed our professor on this question: how much should we raise? And he finally suggested, if you don't have any other rule of thumb, use my rule of thumb, and that is raise twice as much as your projections say you'll need. So you double the 35,000, raise 70,000, or at least have that much available as a contingency. When I started my first business, which was just 2 months after I got my MBA, I've started four businesses. I'm sort of a serial entrepreneur, but my first one, the projection showed we had a negative cash flow, this number down here, of $250,000 before we broke even. And so I followed my professor's advice and raised $500,000, and we ended up using for the Aztec software business about $480,000 of the $500,000. We broke even in exactly the number of months we projected. Like here, it's projecting December gets to break even. We had projected 8 months to get to break even, and it was exactly 8 months. But it had been very volatile during that 8-month period, and we actually burned through all but $50,000 of the $500 that we'd raised. But you've got to make your own estimate on how to come up with a number you're comfortable with, or have a contingency plan where you can raise more capital if you need to. Any questions on how this works? It's important to sort of understand the mechanism of what's going on here. Again, it's the yellow items that change from the previous slide. So it's the cash burn. By the way, if you take a accounting course or a finance course, I even taught it in my entrepreneurship course here for the last 10 years, it is a way to do a break-even analysis where you can have a line that shows your fixed costs, another line that shows your variable costs, and then when your revenue crosses that diagonal, that's your break-even point. You can really see it graphically very easily if you do a break-even analysis. kind of recommend you go through that. We're not going to do that tonight, but it's really a question of how much for contingencies, or my professor's rule of 2x, 2 times what you think you'll need. Let's talk next about the sources of capital and how you find the money you need to actually launch your business. One of the trade-offs is a trade-off between equity versus debt. You can raise money from equity, which means that the person who provides that capital to you owns a part of your business, or you can raise money through debt, which means that they do not own part of your business. You still own it all. So you say, well, I like equity better because debt I have to pay back. Equity I don't have to pay back. But on the other hand, you're going to have to pay interest if you have debt. You're not going to have interest when you have equity. So there are all these trade-offs going back and forth, and there's always a big battle. Which should I raise, equity or debt? And the simple answer is when you're just starting out, you pretty much got to have it be equity, because anyone that's going to lend you money in the form of debt is going to want collateral. You probably don't have any collateral up front, except for the PCs you bought or your chairs for your office, $9,000 worth of stuff. That's not going to go very far. And the bank or whoever's lending you the money probably don't want your used computers anyway. So what my advice is to start at the top here and go with your own personal sources, the ones under the first category. Your own savings, investments, credit card debt. By the way, credit card debt is the #1 source of capital for entrepreneurs starting new businesses. It's risky because if you don't pay it off on time, they have very high interest rates. So it's not something I ever used when I was starting any of my businesses, but it's actually used very commonly because it's easy to get credit card debt. You get these things in the mail all the time, and they're willing to, lend you money by giving you a line of X $1,000 on the credit card. It's another business of Capital One Bank. We won't get into that one tonight. I really lean toward family and friends. And I'd lean toward equity when you're starting out, because that's really the only option you're going to have. Because if you have family and friends doing the investing, as opposed to people you've never met before, it's going to be much easier for you to manage that relationship as you're starting your new business. When I had to raise $500,000 for my new business, I actually went a little bit beyond family and friends and did some networking and met other people that really qualified as what you'd call angel investors, and they helped me hit that goal of $500,000 for that software business I was starting. But under family and friends, it says be careful. And the reason it says that is that because these people are family and friends, you don't want to ruin a relationship that you currently have by not treating them fairly or not, working hard enough to return the trust that they're putting in you by investing in your business. When I went to a lot of family and friends for my first business, and so after the first couple of years, when I'd broken even and I had some money in the bank, I started my first offer to buy them out if they wanted to get their money back plus a return. I'd sold the shares for $1 a share initially, and so after, I think it was 2.5 years, I offered to buy them out for $2 a share because the company was profitable and growing. And by buying the shares back, that would be more ownership for the other shareholders, of which I was one. So I liked that. And if they wanted to cash out, that kept the relationships very friendly within the family and friends. I mean, you probably have heard stories about families that have split apart over business deals where somebody's not talking to their uncle anymore because the uncle loaned him money for something and never got it back, and there's a real schism in the family. Same thing can happen with close friends that invest in your business. You don't treat them fairly and pay them back. So my advice is offer a buyout later if possible to reward them and give them their money back if they're family or friends. Angel investors are going to want to read your whole business plan. They're the more sophisticated investors. They can invest sometimes $100,000, sometimes more than that, but they're going to want to really, drill down and look at it carefully. They probably would like to be on your board of directors and be involved because they're going to put a lot of money in compared to family and friends. And they're going to want to know answers to questions like, what is the ROI? Who knows what ROI is?
Return on investment.
Return on investment, thank you. So I'd like to next introduce
one, and I work in an area called community development banking. It's, you might think of it as kind of a nonprofit part of the bank. And my job is working with a variety of nonprofit organizations in the DC metro area, Maryland, DC, and Virginia, that do training, technical assistance, and lending to small businesses. And often those are startups, or those are businesses that are not bankable by Capital One or anyone else. And everything that Steve said is not about just Capital One. It's about bank financing. It's really, 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 really hard to get any startup capital from a financial institution. So we have relationships with, meaning Capital One, with 3 nonprofit micro alternative lenders. Is there anyone here heard of microfinance? The term microfinance, probably a lot of people do. So most people tend to think of that as being international microfinance. There's Kiva, there's the idea that you can pledge $25 and help a woman in Kenya who has some small goats and whatever. Well, that same thing in this country tends to be called micro-enterprise development. So microfinance, micro-enterprise development are pretty much the same thing. We have relationships with 3 nonprofit lenders, and I'm going to tell you the names of them because they could be a source of capital for your business. The first one is LEDC, stands for the Latino Economic Development Center, LEDC, and their website is like ledcmetro.org. And they do lending. They also do training and technical assistance. You do not need to be Hispanic to partake in their services. However, they do have quite a large Spanish-speaking staff, so they cater to, or they're especially accessible to individuals who are Hispanic and who are starting or trying to grow a business. And they do lending in DC, Maryland, and Virginia. The second one that we work with is called the Ecdc Enterprise Development Group. Ecdc, you can just Google Enterprise Development Group, but Ecdc stands for the Ethiopian Community Development Council. That's an organization that was started quite a long time ago to help Ethiopian refugees that are coming to this country. And they still do that. But then they also created an offshoot, a nonprofit that's affiliated but separate, called the Enterprise Development Group. So they do lending as well, and they also do lending in Maryland, DC, and Virginia. Excuse me. And you do not need to be Ethiopian to qualify for lending from them. The third group is called FSC First. FSC stands for Financial Services Corporation, but they just go by FSC First, and that is in Prince George's County, and they only do lending in Prince George's County. I need something to drink. Cups over here? No, that's right. I'm not talking much longer.
Sorry.
So their lending is just in Prince George's County, but they also do SBA 504 lending statewide. And the Enterprise Development Group also does some SBA lending. So those are 3 organizations that you might want to check out. A 4th one, which is not an official partner of ours, but a group that we're probably going to bring on as another lender. It's based in DC, and it's called WACIF, WACIF, and it stands for the Washington Area Community Investment Fund. And they actually participated in the expo that GW did last year. That was an expo associated with the business plan competition, or
It was just university-wide. It was over in Marvin Center. Some of
Right.
you may have attended that. Yeah.
and actually we supported them to hire a GW intern for the summer, and they had a GW student that they met at the expo, and who they loved, who worked for them for pay for the summer with a grant from Capital One. So they're another organization. They do lines of credit, not term loans, and they also do training technical assistance. All right, I haven't had any problem speaking all day long. So this is something that we do. It's a service to the community. Most banks don't have such a relationship, so this allows us that if a business owner comes to the bank and cannot qualify for financing, they can get referred to an alternative lender. And the loans go up to $50,000, with the exception of some SBA loans that will go much higher. So in some cases, these are businesses that are just looking for $10,000, $5,000, $10,000, $20,000. And so this is the source. It's very, very difficult to get any bank, Capital One or any other bank, to loan you $5,000, to loan you a small amount of money, because the administrative expenses associated with a grant, a loan of that size, are the same as a loan of $200,000. So why would a bank do that? Would you agree with that, Steve? Since I'm not a banker, I should probably turn to you and say, is that true?
No, okay.
Not a banker. Sorry, the Capital One's policy is that we don't videotape presentations by our banker. Anyway, so
Good.
if anybody has any questions about the Second Look program, I'd be happy to answer them.
Thank you, Nancy.
Nancy, thank you very much. That's really good information. Micro enterprise development, keyword you need to know. Alternative lender, another keyword. And the 4 that Nancy referred you to, if you can't find them or forgot what the name was, shoot me an email and I'll give you the link to their website. I'm easy to locate. I'm just jrollins at GWU.edu. So let me know if you have any questions on that or anything else that comes up. I want to go back to our spreadsheet. Now that we've got our question answered about how much capital we want to raise, and I've come up with a way to get the total up to $70,000 through financing activities. This is a bank loan out here in the form of debt, or maybe a micro enterprise development alternative lender loan, I'm not sure which, secured by accounts receivable that you develop over a period of time when you're in business. So this is solid. In fact, my experience is whenever I've gotten a line of credit from a bank, I not only have it secured by an asset of the businesses like accounts receivable, which are up to $10,000 at this point, but the bank also wants a personal guarantee. And that's pretty standard. You know, when you're an entrepreneur starting a business, they want to have double collateral, if you will. So if for some reason the accounts receivable aren't there, they can turn to the owner of the business, the entrepreneur, the person that started the business. So don't be surprised if that happens. But in my hypothetical way to get to the $70,000, which was the 2X formula, we did $25,000 by winning GWBizPlan competition, which you could certainly do. In fact, the second place team last year got 10,000 for second place, 10,000 for being the best undergraduate team, plus the Audience Choice Award. And between those three, they won almost $25,000. So there are different ways you can win money in this competition. And then the founders are putting up 10,000, and they're raising money from outside investors for 25. And then when you combine those three numbers, that 45,000 with this, excuse me, that 60,000 with this 10, you get to from the bank on the line of credit, you get to the total of 70,000, which is the 2x. So that sort of fills out the spreadsheet with the financing activities, and then you get the whole picture here, where basically with this combination of activities, you never have a negative cash flow on the bottom line, which is, you recall, these were red numbers before we put the financing activities up here. Questions on this cash flow projection? On the operating activities, on the investing activities, or on what we just added at the bottom with the financing activities that enable you to keep that bottom line, your net cash flow down here, positive? Yeah.
So in the final stages, how much of the work that went into the estimates kind of displayed on the sheet do you want to see? Because if you only have 15 pages and you have data for each one of these columns on why you picked that term, how would you suggest displaying that? I mean, usually you would just leave it on the computer, but you can turn it in hard copy.
Good question. So the question is, how do you fit this all in your 15-page business plan? And the answer is, we allow you to have 5 pages of appendices, so you can actually get up to 20, but we don't want the written part of the plan to be more than 15. So if you have any large tables, you could have a large table in your market research section where you've done some surveys or something like that, and you want to include those tables in an appendix. You could do that. Or anything else that's useful to making your business plan look great for the judges. But definitely any big spreadsheets, definitely tuck those back in the appendices. And go ahead and include in the actual text, the bottom line stuff. You'd say, we're going to raise this much in outside capital, and we're going to raise this much from bank debt, secured by receivables, whatever. So the narrative carries the gist of it. But then for the Excel spreadsheet, put it back in an appendix. Any other question? Okay, I want to turn next to, as I promised, the financial tool that's based on Excel that enables all this to work. And again, this is available on the GWBizPlan.com website. You can download this exact tool. And basically, it's a fill-in-the-blanks approach. And I'm going to demonstrate it in just a few minutes, but let me just give you the overview first. You start out with a blank spreadsheet. It just has lines, blanks on it for each of these categories. Up at the top, the first between the blue lines is the sales section, where you actually put in the model of how much you're going to sell, how many units, at what price. And this one has room for up to 4 different kinds of products. And then the second section has to do with all your expenses, your cost of goods sold, selling expenses, payroll, G&A, depreciation. Actually, it fills in that automatically when you put in your capital expenditures. There are a lot of things that are automatic, but the ones that are blue are the ones you can fill in. The ones that are black, the Excel spreadsheet will automatically fill in for you. And then it takes all that information from the first 2 sections and turns it into a cash flow at the bottom. So it's a pretty powerful little spreadsheet. Actually, there's another model on the website, on the GWBizPlan.com website, that's far more sophisticated than this. It's one used by PricewaterhouseCoopers, PwC, and it gets into a lot of detail. And if you're a finance major, you may want to take a look at that one. But this one is really very simple and intuitive. that's just based, in fact, both of them are based on Excel. You can do very complex models in Excel like PwC did on that one. But we're going to show you this one next. Spreadsheet that we loaded. Thank you. This is the live version of it now. You can start up here at the top by filling in a name of your company. But then the fun part is actually going through and filling in some actual information. As you go down here, you'll see there's a place to put in column that we really haven't talked about called the beginning column. This one over here under column B. And in case you have anything when you're beginning, like let's say you had some money of your own or from your partners, you put in, you see how it automatically populated a whole bunch of fields just by typing in $20,000 of cash in one cell to get you started. It's a good place to start with putting in something. And then you put in your product assumptions. Let's say you've got two products. You got one you sell for $25. And another one you sell for, I'm sorry, I didn't put that in the right place. Actually, that's too cheap. I don't want to make that assumption. I'm going to make this a $1,000 product. I'm going to make this up as I go along here. And automatically, I put in the $1,000 for the product in year one, and it has an adjustment, inflation, where it'll automatically assume it goes up 5% a year, which is what's baked into it now. Or if you want to change this from 1.05 to 1.02, if you want to inflate it 2% a year, you can easily change that and it'll inflate it at a different rate. And this is obviously doing a 5-year forecast. Let's say you got a second product that's your fancy version of the $1,000 when it sells for $1,500. And let's say on the first one you're going to sell 25, and your business is going to grow. You're going to sell 50 the second year, and 100 the third year, and 200 the fourth year, and 400 the last year, something like that. And see, it did all the math, so we know exactly what. In fact, you see it's populating the section down here under the income statement too. Then on the second product, it's the $1,500 one. Let's say we're only going to sell 20 of those, where we sold 25 of the other one. And we'll just double those going out too to make it easy to demo. Okay, now we look at that. At the end of the 5th year, we got $1 million business, $1,062,000 in revenue.
I'll finance you at that point.
Good. Okay, we got a deal here. Capital One. And the assumption it automatically makes on cost of goods sold is that they're 80% of what your revenue or sales number is. And again, you can change that up here at the top. You see the 0.8, you can make it whatever. Cost of goods sold or 0.5, 50%, like in the previous spreadsheet we were looking at earlier, you can make that a 0.5, or do whatever you want with it. So it's very malleable. Let's see, what else should we fill in here? Let's put in some payroll. wages, salaries, and benefits. The first year, you're a good entrepreneur, you're going to work, maybe say you're going to work for nothing the first year. Second year, you want 50 grand. And the next year, 100. We use this same approach of doubling every year. See how much money we can be paying ourselves and all the other staff. By the end of 5 years, 200,000, 400,000. You have to put in realistic numbers when you do these, because judges are going to look at it. They're going to, if you have zeros in there for salaries, they're going to tell you your business isn't viable. Ed's shaking his head. Yes, he knows it. He's been there. Do you have a comment, Ed?
Yeah, you know, one of the major mistakes that you guys make, or not you guys, but the teams make, is really not knowing your numbers, putting fluff in there, and just trying to do quick. You know, I got to get this done. I got to fill in the columns, and it just doesn't work. It'll shoot against you. And then on the verbiage, I wanted to say earlier, you know, don't put fluff. Don't fill the page just to see words. I mean, because they're going to judge you, and we're going to judge you. You know, tough.
You got to be realistic with your assumptions. No fluff.
No.
Thank you, Ed. That's good advice.
So if we put in numbers there and you're saying you don't want fluff, like a lot of these are estimates for sure. Would this be a good place to have the extra slides and the appendices? Could we maybe give judges, instead of paper, like there's a lot of iPads out here, you know, are people allowed to look through those?
Yeah, and this whole thing would go in the appendix, and you would only talk into 15 pages you write about those items you felt like talking about. You wouldn't have to talk about every one of these at all. They could look back and see. But if you say something in your text about salaries you're going to pay, and you're going to have 4 partners making $100,000 each, and then they look back at this and they say, I don't see $400,000 in there until the very last year. You know, that's fluff. They want it to be realistic. So if you make a statement in your business plan in the text that's not supported by this, they'll probably catch you on it, because they like to look at numbers. In fact, did you know that if you're handing out a business plan or doing a business plan presentation, hand out PowerPoint slides, whatever, what the first section is that the investor looks at before any of the other 7 sections? Finances, this one. First place they start. Some people will read the executive summary first and then turn to this. But the ones that have been doing this a long time, they start with the financial projections, look at that first. Then they read the executive summary at the beginning and go right through it. So this has to accurately reflect, as Ed said, everything you said in the 15 pages.
You know, and you can say, you know, see attachment, whatever, appendix A, B, C.
Yeah.
But
in fact, you should reference the appendices in the paper. Just it's good a good writing style to take your reader back to the appendix at the appropriate time. The next slide is called General and Administrative Expenses, often referred to as G&A. And I think in the other sample we had up there, we had $1,000 a month for rent and phones or whatever it was. So why don't we put $12,000 in there? Now, the nice thing about this, it really doesn't change, you know, for this period of time, because that's just your rent. Hopefully it's going to be reasonably stable. So we could just copy that into all these cells out here real quick, instead of just typing it into just a shortcut.
that's a great
Well, we're
tool.
still getting some negative numbers down here. This net income down here is negative 15,000. Ending cash balances are negative here. So we're going to. Oh, I know what. We haven't put in any capital yet, other than our $20,000, the financing activity. So let's look at financing activity. So right here, these are blue things you can fill in. Let's say we want to raise $10,000 from outside sources at the beginning. Let's see what that does with our cash flow by having that 10,000 in there. Good. The ending cash balance is now positive all the way across this row here, row 45. That's good. That fixed that. Oh, but we got to buy some equipment stuff. We haven't put in our investing activities, capital expenditures to buy a server or whatever we need for the office. Let's put $5,000 in there. See what happens. That's good. We're still positive on our cash flow. So you can play with this. You can do whatever you need to. Oh, $20,000 I put in. It's giving me a red alert down here. Balance sheet check must equal 0. I forgot to issue stock to myself for the $20,000 I put in up front, because that's equity. Okay, so I issued $20,000 worth of stock. Okay, now that balance sheet check equals 0 the way it should. And it puts that common stock in, $20,000 worth of stock plus, and the reason this is 30 is I sold $10,000 worth of stock up here on the investing activity, so it automatically gives me 30. So I don't even have to, if I can hit these projections, I don't have to raise any more capital. I have basically $30,000 worth of equity capital, $20,000 I put in up front, and $10,000 in my financing activities, and the cash balances all came out positive. I've got, wow, $240,000 cash balance at the end of year 5. This looks like a pretty good business. $1 million of revenue. Who wants to be my partner here? But anyway, you see how it works. It's sort of like a little game you can play, and so this is available on the website, and I recommend you use it, unless you're like the guy I'm going to introduce next, who is with the Venture Capital and Private Equity Club here at GW, and he's a master's working on a master's in finance. Is that right, Sam?
Yes, sir.
Okay, and I can also tell you that he's one of half a dozen members of this club who are going to make themselves available to teams, some of you in this room potentially, that feel like you need help doing this stuff, because he lives and breathes this stuff, as does Matt, his buddy in the club. You're in the same club, right? Yeah. So, Sam, if you could say a few words about that and how you could team up with some of these new businesses to help them out with their projections.
Sure. Of course. As Mr. Rollins said,
could you stand up here?
Just sure, of course. Wow.
Yeah.
I can't imagine my luck of actually getting introduced and speak, and I apologize. This is kind of an ad hoc thing, given the fact that finals are happening now, so a lot of the members are kind of scurrying about trying to figure out how to do that. But there's a group of us, and it's a relatively new club that we formed called the Private Equity and Venture Capitalist Club. There's about 10 to 15 members on any given day, growing. As I said, it's a new club. One of the services we want to provide is to team up with you guys and help offer financial services to do things like this, to sit down one-on-one and consult and just say, okay, this is what we think cash flow is going to be. This is our initial sunk costs. Depreciation is going to be this, and help you guys come up with these things. I think at the end, maybe what we can do is we'll pass around an interest list, so we can team you guys and you guys and whatever business you're doing with perhaps some of our members that are interested in that particular genre as well, and just give you guys some time to develop a little bit better ones of these, because I guess as we said in the past, financials tend to be the numbers that get fluffed over, and hopefully by us helping, we'll avoid that. So I think toward the end, I'll get us here a little sign-up sheet, and if anybody's interested in something like that, it'll be our pleasure to help out.
Great. That is a very generous offer, Sam. And Matt, we thank you both for being here to offer that. In fact, why don't we start a sign-up list around right now? You got a sheet, or go meeting if you want?
Do you mind? Well, we have
There you go.
That's
That's
very
good.
good.
That's good. And just put your name and email address on there, and also the type of business. That's really the key, because the genre or type of business, we want to match someone in your club with a business or industry that they really know something about. While that's going around, I want to go back to this model and show you one other feature that I didn't touch on. There's a second tab on this spreadsheet. Down here at the bottom, you see it says Exec Summary. If you click on that, it goes to the second tab, and this summarizes the whole income statement for the whole 5 years in a little tiny matrix like this. And you could put this actually in a little box in the first 15 pages of your paper, even though the big spreadsheet is back in the appendix. That way the reader could see how you got to $1 million in 5 years, what the expenses were, and what the gross profit was, what the operating costs are, net operating profit, and then cumulative profit. It looks even better when you look at cumulative profit. Wow, it adds up over that 5-year period.
Is there a user guide on the website to walk you through this?
It's a toy. You just play with it. Just dive in and just start using the blue entries. There's no user guide.
Well, like with the stock thing, I might not have known to fill in that.
Yeah.
That you filled in.
Well, it gives you that reminder by giving you the red numbers. If you leave it out like I did the first time. But obviously, if you're going to put in money, you've got to get something back for your money. Either it's debt or it's equity. And I put it in here as equity. I issued stock. I could have made it note payable if it were debt. See, line 57 has a note payable entry. If it was just a loan I was making of $20,000. Let me try that. Let me change this back to 0. And
They
Oh,
have
I see.
it gives me the red numbers.
to help.
And then put this in as the 20,000. It didn't work, did it? The answer is you get one of these guys from the Private Equity and Venture Capital Club to help consult with you to make sure you get your projections right. My assistant, Kevin May, just came in. And Kevin, one of the things I wanted to mention is where on the GWBizPlan.com website we have these financial tools. The
Resources, past presentation. There's
resources.
if you go to...
No, I'm sorry, for these spreadsheets that do the modeling.
I put that in the same section,
Okay.
just because that's where we had all the other...
The resources tab, you go down to the past presentations.
There's and it'll say financial spreadsheets, and there's a zip bundle that I believe has 2, maybe 3 documents zipped in it.
There's one by PwC, I know, in there, and then there's this one we're using tonight.
Yep.
And there may be a third one.
So
it's like too.
I put it in past presentations because we've given this presentation in the past, so it's
There
actually...
you go. That's the logic.
Yeah.
So that's how you find it. I'm going to go back to the PowerPoint for a minute and finish up. And really, this is just a sort of a summary of some reminders. When you're doing your executive summary and submitting it to compete in the business plan competition, it needs to be in by January 28th at the latest, technically by midnight, by 11:59 p.m. And one of the things that some people miss in the rules is that we've got a standardized approach to type size and margin width and typeface. I think it's Arial 12 with 1-inch margins. But read that detail in there, because if you submit a plan and you, instead of using 12-point, you're using 8-point type and you're getting twice as many words in, that would give you an unfair advantage over another team. So that's why we're standardizing on, because you can't go over the 2 pages in your executive summary. So the second bullet is just a reminder that you need to make sure you're in compliance on that. Maurice?
If such an error were made inadvertently well before the deadline, is there time get a second shot at it, or you just take it at the deadline and that's it?
We're pretty gentle, actually. What do we do, Kevin, if somebody sends it in with the wrong typeface and they're well before the deadline?
I typically look at it and I send them feedback, and to be completely honest, I've actually even converted people's font type in the past. I don't like doing it, so please don't do that to me. But I've done that, and so if you're at 8, we'll bump it to 12, and then if it goes over the page line, we just cut it at where it goes over. So we really do everything we can to try and not ping you guys for it, but there's a high correlation between people who follow the guidelines and their advancement. So
Right.
attention to detail is very important.
And what I heard Kevin say is if it's too many pages, we cut it.
Yeah.
Which means your last paragraph, which is probably your most important message to the judges, never will reach the judges. Can we notify the winners by February 11th, which is 2 weeks later? Give the judges 2 weeks to go through. We had 144 teams that entered last year, and so it takes them a while to read all those and rank them. We triple read them. We have 3 judges read each one so that we don't miss any good ones. We want to get all the good ones moving into the semifinal round. Any questions? Sam?
Can you go over the decision process? I guess so this is the screening, the preliminary
First round screening.
First round screening. When do we have the opportunity to verbally present?
That's round 3. Let me go through the 3 rounds. First round is a 2-page executive summary that we've talked about. Second round, actually we talked about 2. You expand it into a 15-page business plan with up to 5 pages of appendices. And if you make it past that, you're in the finals. And 8 teams make the finals. And at that point, you have opportunity to stand up in front of a tiered classroom, maybe 100 people there watching, including judges on the front row. And it's a pitch, PowerPoint-based pitch of your business. And after your time is up, they'll ask questions, they'll fire questions at you for 5 or 10 minutes while they're filling out their score sheets. And at each one of these stages, first, second, and third, you get written comments back from the judges so you can improve your plan as you move forward. And obviously after the 3rd round, you're improving it by launching a better business based on the feedback you've gotten.
Is there a percentage that makes it through the first round?
I can tell you last year 32 made it through the first round to what we call the semifinals, writing a 15-page plan. But we'll always, I think, stick to 8 to make the finals. And then you really have to be in the top 4 to be guaranteed funding. Although with the addition of these 2 new prizes, the Sustainable Technology Prize and the Older Adult-Focused Innovation Prize, could have, and the Audience Choice Award. I mean, if all those go to 3 different teams, plus the first 4, 7 of the 8 teams might get funded with some amount of money.
One could be undergrad, it could be all 8.
That's right. We have 10,000 for the best undergrad. Kevin's right. We could fund all 8 this year if they're spread out the right way. But on the other hand, if you win in 2 categories, if you're in first place, plus your undergrad, plus your sustainable technology, you get 25, plus 10, plus 4. So and an Audience Choice Award, you can pile them up. Ed?
Just a comment, it's an extremely comprehensive analysis and methodology that they have put together for us, for the judges.
For the judges, it's very, very quantified.
It's very quantified. It's very, very fair. I have never seen anything like it. So they've done a great job, and the judging, the teams are judged extremely fairly.
We even look at judges' scoring tendencies, and we mean center their scores, and we look at standard deviation changes instead of just raw scores, in addition to all these other things we're talking about. So.
That's through the statistics club help.
Unfortunately, as a doctoral student, you become a statistics club in and of yourself. So.
Yeah, Kevin is our statistics club. Other questions? Yes, sir.
Do we have to provide a prototype or anything for our business? Prototype?
Prototype? No. The pro forma of cash flow, but no prototype of your product is required. Although I think last year we did have a couple of prototypes in the finals, and especially I'm thinking of the one that was the biomedical device. It was a non-working prototype, but they actually had built this device that they could pass around. The judges could look at it, sitting around the front row, and they won. They're one of the 4 that got seed capital for their business. iMagnus Biomedical was the name of that company. Sam?
Caveating what I said before about financial help with the PVC Club, for some people that might be looking for students to team up with, being alumni, I know that many members of the club are very entrepreneurialistic, and they would also be people to pitch if need be.
That may become a partner, you mean? Or
Yeah,
the sponsor.
I was going to ask
Yeah.
afterwards, but
sure. No, I mean, obviously they're not stupid. If they see a great investment, they may want to be a founder. And by the way, on the website, if you're looking for co-founders for your business, if you're a one man or 2-person team and you want additional members, again, on the website, we've partnered with cofounders.com.
Co-Founders Lab.
Helpfounderslab.com. Thank you, Kevin. And you can find that link under resources.
Resources networking. The actual URL is GWBizPlan.com/networking.
GWBizPlan.com/networking will take you right to the Co-Founders Lab information, so you can actually sign up. And this is a site that actually matches other individuals with what you're looking for to start your business. So they help you find a co-founder. That's why it's called Co-Founders Lab. Other questions?
This presentation you have up now, will that be available? The one that you're showing now?
Yeah, we put all these out in the video both. It'll all be on the site.
Those yellow areas would be
Under the resources, past presentations.
Okay.
I wish I would have had these tools and this support when I was getting started and launching, because you can't believe what they have for you. It's so helpful, it's unbelievable.
Yeah. Well, thank you, Ed. And how many businesses have you launched?
4.
4. There you go. Michael?
Do you have the, between the semifinals and finals, I think we came in and gave our presentations to somebody that would give us some assistance in improving them before going to the actual meeting. Is that still?
Yes, that's another resource we offer. If you make it to the finals, one of those 8 teams, like Michael was 2 years ago, we actually have a presentation coach who's an expert on this. She's actually a professor of marketing who, among other things, brings GW a lot of awards in case competitions and in other kinds of presentation type competitions around the university. And Professor Maddox actually works one-on-one with each of those 8 teams.
That was extremely helpful.
Wasn't that good?
Yeah.
She's very good, yeah. So through these workshops, which, and again, we're video capturing as many of them as we can, and then through the feedback you get from the judges, and also, haven't mentioned mentors, but if you make it past the first round, your team will be assigned a mentor who's a experienced, seasoned entrepreneur, business executive who will actually work with your team as you write your 15-page business plan and develop in the final round your 15-minute pitch to make to the judges. So mentorship, as you've been reading probably a lot of literature recently, is probably as big a help as any other single thing. And so that's why we put a heavy emphasis on it here at GW.
Anybody not signed up that wanted to be?
Is the paper made all the way around? Okay. If there are no other questions, thank you very much for being here.